Your mic is off.
You're on mute.
Good evening, everyone. Welcome for today's session with HDFC Fund Managers on HDFC Pharma and Healthcare Fund and HDFC Technology Fund. Today, we have two guest speakers from HDFC AMC, Mr. Nikhil Mathur, who is a fund manager and senior equity analyst for HDFC Pharma and Healthcare Fund, and Mr. Balakumar B, who is also a fund manager and senior equity analyst for HDFC Technology Fund. To brief you about Nikhil Mathur, Nikhil has collectively over 12 years of experience, of which 8 years is in equity research and 4 years in other corporate roles. He has joined HDFC AMC in September 2021. Prior to that, he worked for more than 4 years with Ambit Capital Private Limited, where he was leading equity research on healthcare sector in India. Nikhil also worked with Goldman Sachs India Private Limited for 2 years, where he was a part of a global investment research division. Nikhil has done MBA in finance from IIT Ghaziabad in 2013, done graduation in civil engineering from Punjab Engineering College, Chandigarh in 2009, and cleared all the 3 levels of CFA program. That was about Nikhil. Now coming to Balakumar B, who is a fund manager for HDFC Technology Fund. Balakumar has overall 12 years of experience in equity research, consulting and application development. He joined HDFC AMC in September 2021. Before this, he has worked with Sanford Burness India Private Limited as an assistant vice president. Balakumar holds BTech in IT from Coimbatore Institute of Technology, a PGM from IIM Calcutta, and also a certified financial analyst. Welcome, Nikhil and Balakumar, for today's session. Thank you so much for your time. Over to you, Nikhil.
Sure. Thank you so much, Rati. Good morning, everyone. Sorry, good evening, everyone. So the way we have structured this presentation is that I'll be speaking on the Pharma and Healthcare Fund, which we launched recently, and Bala will take over and he'll speak about the Technology Fund. And then after both of us have spoken, we'll take questions that you might be having. So let me take the Pharma and Healthcare Fund first. I'll make a short 8-10 minutes of presentation, post which Bala will take over. So just to before diving into the details of the fund or what are the growth drivers for this particular fund, I'll just highlight that this fund is already live now. End of September, the NFO closed on 28th September, and we went live from first week of October. As far as Pharma and Healthcare Fund is concerned, I think I'll highlight the key themes that this particular fund is likely to invest in or is investing in currently. So when we talk about the pharma and healthcare space in India, there are 3 major opportunities that we see in this particular space. The first is the domestic opportunity, which is driven by the domestic healthcare spends. The second is the exports opportunity. Historically, pharma has been more about exports, especially to the US, than about the Indian market. But I think the exports opportunity has been relevant in the past and will continue to be very relevant in the coming decades as well. And to marry the two opportunities in domestic and exports, we have the manufacturing leadership that this country enjoys, which will be a further enabler for this entire space. If I talk about the domestic market is usually played via the pharmaceutical space, via hospitals, via diagnostics, and there are new emerging spaces as well in medical devices and retail pharmacy. If I talk about the domestic market, the underlying growth driver for this market is basically the domestic healthcare spend. If we talk about the India as far as the healthcare spend is concerned, I think the penetration is yet to see a meaningful uptake when I compare it with many other countries globally. If I talk about healthcare to GDP spend, we are at around 3.2% versus many other economies which are above 5%. In fact, US in terms of healthcare to GDP spend is almost 16%. So I think we are quite underinvested as far as our healthcare infrastructure is concerned. The second is that in the country, there is a rising population of elderly people. While Indian demography is an advantage in multiple sectors, I'm not alluding that we as a country are aging in a big way. We still are a young population and will remain so in the foreseeable decades. but there is a absolute pool of elderly population which is increasing in the country. To give some numbers here, almost 9% of Indian population is above 60 years of age group. In next 5 years, the population which will be plus 60 years of age group will be almost 13%. So this 4% increase translates into almost 4.5 to 5 crores of incremental population, which is aging in the coming 4 5 years. And I'm not even counting plus 14 plus 50 years of age group. If I add both of that age groups as well, we are looking at almost one third of US population kind of moving up the age bracket in the coming 5 6 years. So I think increasing population of elderly people is likely to be a big healthcare spend driver in the country. At the same time, the life expectancy is increasing in the country. We talk about various media reports of various disease patterns plaguing this country, so and so things not happening well in terms of the disease burden. But I think what is happening in the country is that with advancement of medical technology in the last few decades, the average life expectancy has gone up. 60 70 years back, an average Indian was living for 50 55 years. Now we have a life expectancy of 70 years. So the longer or higher the life expectancy, the chances of an episodes of hospitalization, the need to have better care for healthcare, that kind of goes up. So I think along with elderly population increase, we have a life expectancy increase, which is likely to drive healthcare spend. And finally, the third driver for the domestic market will be the disease pattern change. More and more lifestyle diseases are plaguing the country, not just in India but globally as well. There are some numbers here from the government bodies. ICMR says that 11 crore population in India is diabetic and almost 13.5 crore population is pre-diabetic in the country. So I think the disease burden is kind of increasing as far as lifestyle diseases are concerned, and which is likely to drive up the domestic healthcare spend for the country as a whole. So I think to if I look at the domestic opportunity, I just summarize the three key drivers for this. We have an increase in penetration that will happen. We have a rising elderly population along with expectancy, and a disease pattern change, which is likely to drive up the healthcare spend. Coming to exports, India has been a big supplier to the US market, even to Europe in the last 6 7 years. To give some numbers here, the medicine supplies from India to the US, they account for almost 48% of volume share now for products which are off patent. So I think this is a huge number, and I think US continues to be a big growth driver for Indian pharma. What we see in the coming 5 6 years is that the number of drugs which can be targeted by Indian companies, that number is quite huge. We are talking about almost $98 billion of drugs which are going off patent in the coming 5 years, which will be targeted by the Indian companies. This number is almost 2.5, 2.7x versus last 5 years. So the total addressable market for Indian companies in the coming 5 years is much bigger than what it was in the last 5 years. The second is that Indian companies have recently cracked a lot of complex products. To give you an example, an asthma inhaler, it takes almost 5 years of development time frame and almost 250 to 350 crores of R&D expense to launch in the US market. Recently, we have seen many Indian companies gaining approvals for such kind of products in the US market. So along with patent expiries, what we have seen is that Indian companies have moved up the curve of manufacturing, the curve of development. So which is why I think a large part of the opportunity, which till now wasn't being addressed by Indian companies, is now opening up to realize better growth in the foreseeable future. And finally, outsourcing is a big trend by the global big pharma companies. You would have heard of global innovator companies, Pfizer's and Merck's and those kind of companies. Now, a typical innovation drug development timeline can take minimum 8 to 12 years, and the amount of spend can go into hundreds of millions of dollars and even billions of dollars in certain cases. Given so much of uncertainty involved in terms of timelines and costs, these companies tend to outsource a large part of development, a large part of manufacturing, which is where in the past 10 years we have seen Indian companies becoming partners to these global companies in terms of contract development and contract manufacturing. So along with the traditional route of targeting off-patent drugs, focusing on complex drugs, we are also seeing Indian companies becoming part of the innovation curve at a global level through these partnerships. And finally, if I talk about India's manufacturing leadership, uh, outside of US, India has the highest number of US FDA approved facilities. I think This is a competitive advantage which cannot be taken away from India in the foreseeable 5 7 years, and this is what will feed into further growth in the coming years. Indian government has launched a PLI scheme. It's a very timely scheme. I think in the coming 3 to 5 years, we'll see a lot of improvement in competitiveness of Indian companies versus, let's say, companies based out of China. We have a labor cost advantage. We have a track record of spending into R&D, which is why I think this theme of manufacturing and R&D leadership will kind of feed into the exports and domestic market to kind of drive growth in the coming years. So I think these are the three key broad themes on which this particular fund is centered around. I'll quickly talk about valuations, which I think are pretty relevant in current time frame. So for this particular fund, BSC Healthcare is the index. On a 1 year forward PE basis, BSC Healthcare is trading at a 27 times 1 year forward PE. Now, this is a 14-15% premium to its last 10-year historical average. I think there are multiple concerns on market being top and the valuations were not being very cheap. I think I quite agree with that point that the markets are expensive. So is the BSC Healthcare Index, which is kind of trading at a 15% premium to last 10-year average. But I think if I look at on a relative basis, if I compare BSC Healthcare with Sensex, now BSC Healthcare is trading at a 15% premium to Sensex. Historically, when pharma cycles have been good, the premium for BSC Healthcare has been much higher to the extent of 30-35% as well. And we strongly believe at HDFC today that pharma and healthcare is in a strong upcycle, which is why I think on a relative basis we see a lot of comfort in terms of valuations for this particular space. And if I look at on an absolute basis, the way we see FY23 to FY26, which is a 3 year time frame, I'm not taking a too longer time frame because if we extend the horizon, obviously a lot of things will start looking good. I'm not taking a too short a horizon as well because we don't believe in a lot of churn kind of a strategy. But if I talk about on 3 year basis, I think there is reasonable growth on offer across all the major segments. If I talk about FY23, there were all kind of cost pressures, whether it is raw material cost, energy cost, freight cost, even marketing and development expenses, which came back strongly in FY23 after 2 years of COVID. So we are sitting at very depressed profitability as far as FY23 is concerned. So what I believe is from FY23 to FY26, a reasonable growth will transform into a much higher profit growth for the entire space, which is why we believe that this is a very opportune time to look at pharma and healthcare as a theme, and hence we came up with this particular NFO. So long story short, in terms of valuations, I think in absolute, yes, the sector is trading at a premium, but on a relative basis, the valuations are quite under control, and we see a strong earnings growth momentum over a 2 to 3 year horizon, which is why I think there is a chance that the sector can degrade relative to the index in the coming 12-15 months. And finally, I'll talk about risk. I think as far as healthcare and pharma is concerned, I think the starting point or the vantage point from which we come at HDFC, we first evaluate risk and then we kind of look at the growth profile of companies in the pharma and healthcare space. I think the one big risk which gets highlighted everywhere, I mean, in media is almost every second other day, is the US FDA risk. My idea is not to suggest that this risk is not there in this sector. This risk has always been there and will continue to be there. But I think the way this risk impacts the sector is very different now, or very less now versus, let's say, 10-12 years back. To give you some nuance here, 10-12 years back, a typical large listed company used to rely on very few plants for their products in the US. Also, some critical products were used to get filed only from 1 or 2 facilities. So what used to happen is that if 1 or 2 plants came under the scanner of US FDA, the earnings profile of that particular company used to go for a toss for a good 3 to 5 year period. But fast forward 10-12 years, and what has changed is that many large Indian companies, they now have multiple facilities to cater to the US market. Along with that, single products are filed from multiple facilities. So even if 1 or 2 facilities come under regulatory scanner, that product or that pipeline of products still has a realistic chance of getting launched. So the problem or the outlook doesn't get derailed in a big way if there is a US FDA issue today versus 10, 12 years back. So I think the Indian companies have evolved to live with this risk rather than completely being subdued by this risk in the past. That's one. The second is government regulations in India. Every other day, we keep hearing something or the other in terms of pricing control, in terms of some state regulations in the hospital space. My point here is that we as a country are highly underinvested in terms of our healthcare infra. While government regulations will be there, the government regulations cannot be draconian. So that because we need a lot of investments into this particular space to come up to the level of what various other emerging and developed economies are in terms of their healthcare infra. So I think long story short is that the risks are there in this particular space. So are risk in various other sectors as well. But I think the risks are very manageable. When constructing a portfolio, we are very cognizant of these risks, and we kind of look at these risks in conjunction with valuations in taking positions in certain stocks. So I think it was important for me to highlight risk because it is very important for this particular sector to be on top of what we are looking at and how we are gauging risk. So I think I'll kind of close now. I've spoken about the themes that are there in this particular space. We see growth across all major segments that we have our Indian pharma and healthcare listed companies are exposed to. I've talked about valuations. Valuations in absolute are at a premium, but on a relative basis, and given the earnings growth profile in the coming 2 3 years, I think the valuations are not a big concern for us at this juncture in this particular sector. And finally, risks are there, but the way to manage these risks is much better than what it was 10, 12 years back. And hence, a reasonable portfolio in a risk controlled manner can be created, which can give us the requisite returns that we want to from this particular fund. So I'll hand over the forum to Bala now, Bala Kumar, and then we'll both take questions, whatever you might be having from both of us.
Nikhil, Ashok here. Before we invite Bala, so just my one take for the audience here is that why pharma fund and why not pharma companies? So generally, when you say "Nikhil, pharma acha lagta hai," तो why let's go and buy pharma companies? So let's understand that each pharma company is a unique company. For example, if you like Cipla, that doesn't mean that Torrent is also having the same kind of business. Torrent business model is completely different. Some people operate in different geographies. Somebody operates in US, somebody operates in Russia, for example. Somebody in domestic market, somebody into formulation. So बहुत सारा variations है as far as pharmaceutical companies are concerned. It is better because a lot of research and development is there, and I think it's better suited if we go through a professional approach and using a fund management specialist rather than going and buying pharma company. Meaning one pharma company is good, that doesn't mean it is applicable to entire pharma segment. So each company is unique, and therefore, even what Nikhil talked about valuation, that valuation in general, there will be some companies which will be available at a reasonable valuation as compared to overall market in terms of its growth opportunity. So every company is unique, and therefore you require pharma portfolio rather than a pharma company exposure. And secondly, you're talking about the pharma is an eternal theme. We don't require much debate on this. It's a central theme to every government across the country. Today, world population is 7 billion people. India is 140 crore people. And even in India, we have Pradhan Mantri Ayushman Bharat Yojana, which is like giving 5 lakh rupee to the low income group people. And that also has started improving the demand for pharma companies going forward. Because either those people who were in low income group were avoiding treatment. Actually were not, after getting diagnosed, were not going, but they don't have money. Now the money is being provided under Pradhan Mantri Awas Yojana or Ayushman Yojana, and therefore people have started taking those kind of treatment, and that makes business for hospitals, that makes business for pharmaceutical companies, and therefore this, in my opinion, is a structural as well as technical coming out of the export potential. So brilliant, Nikhil, for your comprehensive overview, and now I invite Bala to take over his thing. Bala, you can change the presentation.
Sure. Just give me a minute. I'll just change them. Hi, can you see the presentation?
Yes, Bala,
Yes.
you can go ahead. Yeah.
Sure. Thank you. Thanks for having me here. I'll discuss on two key questions which every investor will be focused on. One, from a medium term perspective, why technology as a theme should an investor focus on? And two, the timing aspect, why now? First, I'll try to address the medium term or the longer term question. Why should one invest in the theme of technology? Three main reasons I would say. One, if you look at anything which a consumer does today or which a corporation does today, you could see that the increasing influence of technology across activities. This we call it as increasing tech intensity. This is a secular trend which you can see across markets, industries, or even if you see the lifestyle of a consumer. This is something which has been happening over the past 2 3 decades, and this is likely to continue. And this will be a key driver of technology spends going forward as well. The second reason, if you look at the Indian IT space, uh, we are our forte is services, and services is a strong growing segment within the technology spends. And Indian IT companies have gained market share over the past 2 decades. And if you look at this industry, the technology industry, the key differentiator for any company is talent. In terms of the talent availability, India stands far ahead of the rest of the world. So clearly, if because of the first rationale that the opportunities in technologies grow, then opportunities for India will also grow because of the availability of talent. And the third reason, if you look at the domestic tech market, the companies which are focusing on the increasing digital adoption. So clearly, despite the adoption which we have seen over the past decade, the room for increasing penetration is far ahead. So it's also a medium term tailwind for growth. So for these three reasons, I will show some key charts which will depict why this is a powerful theme. For example, the first one, the increasing tech intensity. So here we try to look at the tech spends from two perspectives. One, from countries' perspective, and two, from enterprises, corporations' perspective. If you look at the tech spends as percentage of GDP for countries or tech spends as percentage of revenues for companies, you could see over a 2 year time frame, the trend has been a secular uptrend. So clearly, this is something which has been happening for the past 2 decades. And if you look at some of the examples which we could relate to, in terms of the Indian retail transaction value, 60% of the transaction is now digital, mainly UPI. About a decade ago, it was zero, closer to zero. In terms of e-commerce penetration, India is today at 7%. 15 years ago, it was zero. And the most important thing is, even if you look at some of the countries, let's say like US or UK or South Korea, despite a higher penetration which they have when compared to India, it's been an uptrend. So clearly, there's been no plateauing. The uptrend has been continuing for the past 15 to 20 years. So the first reason is that the tech spends have been increasing across markets and industries for the past 15 years, and we see the same to continue because it has become a part of lifestyle, whether you call it for a consumer or whether you call it for a corporation. The increasing tech intensity is part of the lifestyle. So clearly, this will continue going forward. And how does this impact Indian IT? Whether we have benefited from this trend and whether we will continue to benefit from this trend, probably I'll show you some key charts here. So if you look at the tech spends can be broadly classified into three segments. One, spends on software. Two, spends on services. Three, spends on hardware. And if you look at the IT services spending, the services spending have been growing faster than the overall tech spends. If you look at the bottom chart, you could clearly see the mix of services, which was 24% in 2010, that is expected to rise to 33% in the next 5 years. So clearly, services is a fast growing segment within technology. And if you look at the performance of Indian IT players, the top left chart, you could clearly see that Indian IT services industry has consistently outpaced the global IT services spending over the past 2 decades. There has never been a year when we underperform. So we have been a share gainer. And this is also reflected in the right side chart. You could clearly see that our market share currently stands at 15%. So the next question, okay, this has happened, but can this continue? Because markets are forward looking. What will ensure that Indian IT can consistently grow ahead of the global competition? I think the key reason is the differentiator. In terms of the differentiator, like I mentioned in the opening remarks, the key differentiator for the industry is talent. And if you look at the talent availability, especially the right side chart here, you could see India produces around 22 lakh STEM graduates. STEM stands for science, technology, engineering, and mathematics. If your person is graduates from such disciplines, then he or she is likely to be employable in the industry. So the potential employable pool for the industry from India is roughly 3x the closest competition. And when you go down the hierarchy, clearly we are multi-fold in terms of the talent availability. So, like I said, if the opportunities in tech grow, naturally they have to come to India. And third, on the domestic story, this is also something which we have seen over the past 10 years. If you look at the top charts, you could see that the number of smartphone users, internet users, online shoppers, everything has grown multifold over the past 10 years. But the most important thing is, if you look at the top left chart here, India's e-commerce penetration today is 7%, and it is expected to double to 15% in the next 3 years. Doubling is not an easy task, but despite doubling at 15%, our e-commerce penetration would be lower than the e-commerce penetration in many of the developed countries, as well as some of the developing countries, US, UK, or South Korea. So clearly, despite the strong growth which is expected in the near term, let's say the next 3 years, the room for growth is far ahead. So clearly, for any firm which is focused on the India digitalization story, they have a long runway ahead. So these are the three prime reasons why we think one should invest in technology sector. Let me let me give you a brief about the fund. So the fund can invest in technology, media, telecom, and internet companies. Apart from these four sectors, we can also invest in the US listed names. Close to up with a max cap of 20% being can be invested in the US listed names, but currently at the industry level there is not much leeway. But if I have to put it from the potential investment areas, one would be technology, second media, third telecom, fourth internet, and fifth would be the US listed names. So let me address the timing question. Why now? Why is it a good time to start investing in the sector now? Uh, for this, I think the we have compared how this sector looks, how this sector fares when compared to the broader benchmark. S&P BSC Tech is the benchmark for the fund. It's a TMT sector, technology, media, and telecom index. And we have compared the fundamental attributes like revenue growth, PAT growth, return on equity, dividend payout ratio, etc. of the TMT sector, BSC Tech Index, against a broader benchmark like BSC 100. You could clearly see from the left side chart that in most of the parameters, the sector stands out. The sector scores ahead. For example, revenue growth, return on equity, dividend payout, they are far ahead when compared to the broader benchmark. And this has also led to uh, a premium which they have enjoyed when compared to the broader index over the past 10 years. But from the timing perspective, if you look at the valuations of the sector has derated over the past 20 months, mainly due to concerns of slowdown in the global economies, US and Europe mainly, because for this basic tech index, the major composition comes from the technology sector. The major composition is from IT services index. IT services is mainly an export oriented sector. And because of anticipated concerns of a slowdown in the developed markets, the sector has derated over the past 20 months. But if I look at the valuations today, the valuations look more reasonable and they look closer to the long term average, 5 year or 10-year average, as you can see in the left side chart. And The right side chart shows the premium or discount of the BSE Tech Index to the broader benchmark. You could clearly see at majority of the time the sector has traded at a premium to the benchmark. So when does one give a premium price to a product? Only when we know that the quality of the product is superior, then we pay a premium price to the product. So clearly, the sector's fundamentals have been healthy, which we have discussed just before, and this healthy fundamentals translated into the premium when compared to the broader benchmark on a longer time frame. But if I look at the current premium, which is around 20%, that has also come down in the last 20 months, and it's closer to the longer term average, let's say the 10-year average. So clearly, the valuations have baked in to an extent the concerns of a global slowdown, whereas the new medium term growth drivers look intact. So the other thing is, I was mentioning that the sector has underperformed in the past 20 months. This table puts the narrative into numbers perspective. You could clearly see at the bottom of the table, if you look at FY23 and FY24 YTD, there's been a 25% underperformance of the sector relative to the broader benchmark. But if one takes a longer term view, let's say we have shown the returns from FY 2008 till date. In FY 2008 to 2023, in 16 years, 11 years, the sector has outperformed. So clearly, if one looks at a longer term time frame, clearly the sector has been an outperformer. But the past 2 years, the sector has underperformed mainly due to concerns of a global slowdown. So if I have to summarize, I think three reasons why one should invest in this thing. One, uh, tech is becoming a part of lifestyle, be it for a consumer or be it for a corporation, and increasing tech intensity is here to stay. And two, if the tech opportunities increase, then naturally India will see more opportunities because India stands far ahead in terms of competition, in terms of talent availability. And three, in terms of the India domestic digital story, despite the penetration which we have seen over the past 10 years, the scope for improvement is far ahead, which gives a medium term tailwind for growth. And finally, the sector fundamentals are healthy, and the derating or the underperformance of the sector over the past 20 months makes it a reasonable time to start investing in the sector. Probably with this, I'll stop and then we can take questions.
Thanks, Bala. And Rati, over to you. Questions and answers.
Yeah, there are a lot of questions. I'm just sharing the screen. Give me a moment.
Sure.
So the first question I think is for Bala, which is related to IT. When US pages are cutting tech cost and big Indian IT companies like Infosys and TCS are giving global guidance on the current geopolitical scene, will there be a longer gestation period for returns to come in IT as a sector? Also, long-term return in IT are still subit.
Okay, got it. Thanks for the question. Let me first address the second part, that the long-term returns in IT are still subdued, because I think in one of the tables which we showed, in 11 out of 16 years since FY 2008, the sector has outperformed. And even when we compare the sector's returns, the benchmark's returns to the broader benchmark, the benchmark has outperformed on a longer term basis. So clearly, from a longer term perspective, I think the sector has been an outperformer. And let me take the first question. Yes, clearly the near term is not rosy, but I think that the key question to ask here is, what are the expectations and what's the reality? Whether the expectations are building for a stronger growth when compared to the reality of, let's say, the guidance cuts from the companies. But I would say that, like I showed in the valuation charts, the valuation has derated for the past 20 months, and the sector has underperformed by 25 percentage points in the past 20 months. So clearly, the underperformance bakes in the near term uncertainty. So whether this will change in the next 3 months or next 2 months or next 6 months, that's a difficult call to make. The key driver would be how the global economies fare. So, but if you look at the major economies, let's say especially the US, which is the key market for us, the economic growth has stayed resilient so far. If I have to put it, the narrative has changed. In the beginning of the year, the narrative was uh, how deep the recession would be. But today, the narrative has changed to whether it will be a soft landing or whether we will hit a recession, and if so, will it be a minor blip or what could be the extent. So clearly, the narrative has shifted to the positive. But yes, definitely in the near term, this will be the key driver how the global growth pans out. But for a medium term investor, I think the key question to ask is whether the near term uncertainty is baked in the price or not. As we have shown, the valuations clearly bake in the valuation derating clearly bake in the near term concerns. So if one has a medium term perspective, let's say a 5 year or longer view, then I think this is a good time to start investing in the sector.
Just to add to what Bala said, that the first question itself, if you believe in efficient market, then this question is known to everybody. So once the risk is known, then markets will not react to it. Just to give you perspective, when first time COVID happened, we were all in shattered and market corrected 40%. Next time Delta wave happened in 21, which was much more lethal than the first wave, but market did not react because then it became a known risk. This is a known risk, which every market participant, at least institutional players, are aware about it. What people must be banking on this, that for India as a country to grow, the digital revolution is driving the India's growth story. And that's what has been affirmed by the highest authorities of this country across the world. And they've been speaking high about our digital revolution. And that's what people are banking on this. That if 140 crore has to move to next level, it has to be because of digital revolution. And therefore, this is a known risk unless and until something new comes out, which you and I do not know. And Bala also does not know. Then markets can really go for underperformance further. Over to you, Rati.
Sure. The next question is, what's special in pharma as a sector for next 2 to 3 years seen? What type of return can be expected in this 2 to 3 year? Nikhil,
Right.
this is for you.
Yeah, sure. So if I look at the broader pharma space, or let me talk about the entire healthcare space first. So there are the ways to invest in the Indian healthcare space is one is via the exports pharma, the second is via domestic pharma, or the third is via healthcare services, which is hospitals, diagnostics, and certain other healthcare services segments. If I talk about the pharma space or the exports first, I think today we are in an interesting phase as far as the pharma exports is concerned. If you remember, I'm sure most of you are aware that from 2015 onwards, there has been a big down cycle in the exports pharma space. COVID time was an aberration because the global supply chains were concerned. So a lot of exceptional stocking happened in 2020, 2021. So the entire returns that happened in FY21 or some part of FY22, they were an aberration. The sector was still in a down cycle. So in effect, from 2015 till about 6 months back, we have been in a big down cycle in the overall pharma space. Now, what is changing? What is changing in the last 15 months is the interest rates. The interest rates today are in the US, especially, are at a stage which haven't been the same in the last 20-25 years. Now, why is this important? If you pick up the balance sheet of any Indian pharma company, you'll find a net cash position, 10% of their market cap sitting as cash in their balance sheet. Whereas if you look at the global companies, all the global companies are very highly leveraged. If you do a simple Google search of US generic drug shortages, you will come across a number of articles which are talking about drug shortages in the US being at an all-time high. You'll also find articles of certain companies which have gone bankrupt because of their over-leveraged position. So what we feel here is that we are in some sort of a cycle as far as the US or the global exports is concerned. Now it is very difficult to call out how big is the cycle, what is the level of pricing increase or pricing improvement can we see in this particular space. I think it's realistically impossible to kind of gauge that. What we are definitely sure of that Indian companies are gaining market share. The pricing environment is much better than what it has been in the last 7-8 years. And third is that the drug shortages in the US are running at an all-time high, which is why Indian companies will continue to gain market share. So of the various segments, I think the export segment is after almost 7-8 years is looking good. Um, though it has to be a bit tactical. The US market tends to be a bit cyclical in nature. So while things are looking good from a 12 to 15-month horizon, we have to be a bit careful of the risk that we will run if we take overexposure to the US or the exports market space. To balance the cyclicality of the exports market, we have the domestic pharma and the domestic healthcare services, which is a structural space. 13, 14 crores of population entering plus 40 years of age group, disease burdens going towards lifestyle diseases, insurance penetration in this country. I think I kind of didn't touch upon this particular point, but if we look from FY16 to FY21, the number of lives covered by insurance has almost doubled to 21 crores. The claims CAGR reported by the IRDA website again during this time frame has grown at a CAGR of 16%. So I think the affordability angle in the country is being taken care of. The supply side angle is being taken care of by various bed additions, the various foray into tier two, tier three markets by the pharma companies. So I think both domestic pharma and the healthcare services is a very structural space which we tend to invest in. So I think if I look at the first part of this question from a 2 to 3 year horizon, what's special? The special is that India has a strong leadership in the exports market, and the exports market in terms of opportunity and pricing is looking much better than what it was in the last 6-7 years. And we have a whole domestic angle which is very structural in nature, which will drive growth in the coming few years as well. As far as what type of returns can be expected in 2 to 3 years, so the way to answer this is a reasonable portfolio that can be created in the pharma and healthcare space. It can give a revenue CAGR of 10 to 12%. We have to be careful. Pharma healthcare space is a regulated space, so expecting abnormally high growth is can be a bit unrealistic. But at the same time, the growth it will not be very low as well because of various growth drivers that I have talked about. But the more important point is what is the profit that we are expecting in the coming 2-3 years. So if I talk about, I'll kind of reiterate the problems that the overall pharma space faced in FY23. Your raw material costs were at an all-time high of various APIs, various inputs, various chemicals. Pharma is a very export-heavy sector, so your freight costs were at an all-time high. Again, it's a very export-heavy sector, so your it's a manufacturing sector, so your power cost, labor costs were at an all-time high. And also, almost after 2 years, a lot of business activity resumed on the ground, which is meeting doctors, travel, and all those kind of things. So your expenses on the business development front also kind of resumed in a very sharp manner in FY23. So our strong belief is that this 10-12% growth can translate into a better uh, uh, bottom line growth from a FY23 to FY26 perspective, which is a 3 year horizon. So low to mid teens can be a reasonable return expectations provided there is no re-rating of the sector. Just on the back of earnings, I think that is a return potential for this particular scheme. But if I go back to the valuation argument that when pharma cycle has been strong, there have been cases where the relative valuation of the sector has been much higher than what it is today. So if that plays out, if let's say the broader market weakens or pharma sector cycle is stronger than what we are able to envisage today, you can see further re-rating of this particular space as well. So I think the long story short, there are multiple sectors to be looking forward to as far as the pharma space is concerned. And within a reasonable 10-12% revenue growth outlook, we can have a 13 to 15% kind of earnings outlook over a 3 year horizon, and that will be the base level returns that can be expected from this particular scheme.
Thank you, Nikhil, for explaining so much in detail and with so clarity. The next question is it right time to invest in sectorial fund as there is a war-like situation in the world? I think this would be a
Ashok,
common question. Uh, Balakumar, you can answer this.
Sure. So let me put it this way, then it's very difficult to take a call. The question here is then we have to understand understand what are the implications of the situation, the unfortunate situation which we are having today on the respective sectors. From the technology sector, I could say that the either the revenue exposure or the supply exposure, the number of people which we have in such regions, they are currently not material. So in terms of the expectations at current stature, it's not material in terms of any impact on the sector per se. So I think uh, probably from a tech sector perspective, I would say nothing material uh, from the current situation.
Yeah. As far as the pharma space is concerned, let us look at the demand aspect and the supply aspect. I think the demand aspect doesn't change war or no war. If people are falling ill, if there is aging happening, if lifestyle diseases are on the rise, come what may, healthcare spend has to be there, whether in the US, whether in India, or whether in Europe. So I think the demand side kind of remains the same. On the supply side, it is very difficult to take an exact view, but let me put some thoughts on this, to share some thoughts. The largest company globally, which supplies medicines globally, is an Israeli company, which has the largest market share. We have no news, we have no reports whatsoever that they are under some sort of a pressure in terms of supplies because of this war-like situation in the Middle East. But my sense is that this perhaps is an opportunity for Indian companies to further gain market share. I think in a polarized world where you have different countries pitted against each other, India still has some sort of a neutral stance. It doesn't have a anti-sentiment, which let's say China is kind of running, or various countries are kind of impacted by a war-like situation. So I think in a polarized geopolitical environment, India perhaps benefits, though I think it's very difficult to give an exact view whether or not we'll gain market share or not. But probabilistically, I don't think things will get worse. So the demand side is looking fine. The supply side at worst is looking the same. Perhaps it can be a bit better for the Indian companies. So I think a war-like situation doesn't really impact the pharma healthcare space in a very big way, which maybe an energy sector might get impacted with if this situation persists. So I think it's an absolute call. I think war or no war. I think as investors we have to uh, look at our own risk appetite, look at our own asset allocation. As far as the pharma healthcare space is concerned, I think it makes sense to have a relative overweight in this particular sector versus the broader market, or certain other sectors. And Bala has kind of very well laid out his thoughts on the sector. In again, war or no war, I don't think it impacts his outlook on the sector in a very big way.
Okay, thank you for that. The next question is pharma sector is not performing from long term from quite some time. At the moment, the market seems to be more unpredictable. Why should we invest now?
So I think the pharma sector, if painted with a broad brush, and if you look at that return, it might not give the true picture of the after actual returns that we have made in this sector by looking at a more bottoms up way rather than looking at a top down way. So let me again share some nuance or some thought here. The top 4 or 5 listed companies in the pharma space, all of them have a different growth driver. One company is a bet on global innovation. One company is a bet on global contract manufacturing. One company is heavily invested in the Indian market. One company is heavily invested in the US generic market. And then you have a hospital name as well. So these top 6 companies, which are the largest listed companies, they all have very different growth drivers. So the problem that happens when we look at a very top-down manner is that at times investing in pharma by looking at it on a top-down basis can be a zero-sum game, because in a particular year, a couple of companies can do well, really well, and a couple of companies can do really bad. So that's why looking at this space from an index level will not make a lot of sense. Whereas if you look at various individual companies over a 3-year, 5-year, 7-year, 10-year period, you'll find a lot of value creation has been done. So I think the long story short is, if I talk about the underperformance of the pharma sector, and that's why I talked about risk. Because if we start with the proper risk profiling of companies and we eliminate the companies which have to be avoided for certain reasons, you naturally land up with a portfolio which is much more robust. So that's why I think looking at pharma from a top down or from index level might not make a lot of sense. And to the question that the market seems more unpredictable, I think we are talking about the more stock market or kind of broader index level market, which is looking unpredictable. I think it's a call whether one wants to be in cash or one wants to be invested in equities. Um, Personally speaking, if my risk horizon is reasonably large, um, I don't think that we can take a big call of sitting on absolute cash. Because as far as my space is concerned, the pharma healthcare space is concerned, I don't see valuations out of uh, not at all in bubble zone. Surely they are not in a overly exuberant zone as well. Like I said, the earnings outlook for this sector is looking pretty good from a 2 to 3 horizon. So I don't think I'll take a big call of sitting on cash and not being invested, because I can see pockets of value in my space despite the markets being where they are. And I think Bala has also kind of well laid out why tech fund is making sense at this juncture, despite all the uncertainties around global tech spending, recessions, and all those kind of things. So I think it's a some sort of an individual call whether to be in equities or sit on cash. Personally, sitting on cash hasn't worked out in well, especially in the Indian context. And with valuations not being in a overly exuberant zone or not being in a bubble zone, I doubt that it will be a great strategy to be sitting on big time on cash and being out of equities.
Just to add to what Nikhil said and I said earlier, when it comes to pharma, which is like a not performed for a long time, but just pick up any pharma sector fund in the market industry and just look for 5 years. Has anybody lost money? I don't think any pharma fund has lost money for its investors. As I said somewhere, it's an eternal theme. And in pharma, only portfolio approach will work, because if you pick up an individual pharma company, it may not perform to your strategy because each company is unique, different from other company by geography, by internal composition in terms of formulation, API, what we don't understand that. This is these two themes, technology and pharma, are linked to innovation and development. So they are more, of course, export is a primary theme, one of the primary theme there, but both are linked to innovations, research, development, and therefore premium valuation to the general market. And therefore, we need to be there, because the moment it strikes, we never know, and you will be, sort of out of money. So better to be invested, remain invested, and believe in the story of India with low cost skills and more talent, etc. etc. That what we discussed. So yeah, if any further questions, let us know.
Next question. IT sector is not looking good due to recession looming over Europe and USA. Why would we invest in IT now? I think in a way it has already been answered. If you want to still throw some light.
This has been a long anticipated recession, and which also reflected in the derating of the sector. But like I said, if I look at the key market, especially the US, the growth has remained resilient. Yes, it has come down from the high levels of 2022, but still the the conversations have pivoted from how deep the recession to whether we will hit a recession or not. And the clear question from a medium term investor is whether the current valuation prices in the potential risk of a slowdown. In my view, the derating clearly factors in the near term risk. That's why, if for a medium term investor, with for us for to invest in a sector with a good medium term growth drivers and fundamentals, this is a good time to start investing.
Yeah. Okay. The next question is, we are advising to invest in thematic fund. Will it not be more advisable to invest in flexi cap and large cap?
Let me take this questions, Nikhil and Bala. Yeah, so the diversified funds like Flexi or large are always core to your portfolio approach. So if you have 100 rupees to invest, you should have a large allocation to this core portfolio, which is flexi and large, because that's where the position can be changed according to emerging opportunities. And we always suggest to our investors, when it comes to thematic or sector funds, limit your exposure to 5 to 10% of your portfolio. So have a controlled exposure, but there are people who have a typical view on a particular segment. For example, you may be having more optimism. So it's a more of a tactical call, and you may think, no, I think India should continue to do as data suggests that this technology or underlying benchmark, BSE Tech as well as in pharma, they continue to outperform the underlying the Nifty 50 over a longer period of time. And so it's a definitely call which is more tactical in nature, but it's more to be driven by your internal belief that pharma fund can deliver. And as I said that if we have just started pharma fund a month ago, Nikhil is a sector specialist, Bala is a sector specialist. They are the best guys to run this kind of strategies. But even if I go and look any strategy which is available in the market with a 5 year plus, I think everybody is a double digit return. So I think the potential to deliver return is there in the underlying themes. And that's where I think people who want to take a control exposure, and more importantly, as Nikhil also said, okay, this pharma sector is coming out of its hibernation for the last couple of years. It has been underperforming as a sector from 2015-16 for whatever variety of reason. It has started coming out and it started actually outperforming in the last 1 or 2 years. And the story will unfold because of the lot of opportunities that Nikhil actually explained. And similarly, in technology, we already have an sort of a underperforming period for last over, you can say, 18 months. And roughly also it may underperform for 1 or 2 mere quarters, but that makes the valuation in line with his overall long-term averages. And as we said, that this is known risk. So again, coming back, core investment remains in flexi and large. And these are tactical calls where you have your own belief. You can take exposure or control exposure of 5 to 10%. You can't make this as your flagship holding. That's for sure.
Sure. That's very rightly said. So I think this question is also sort of answered that how much allocation an investor should make in this
5 to
thematic
10%.
fund. Yeah.
5 to 10%. Yeah.
What should be sales pitch to promote IT and pharma? I think this has also been quite explained in the earlier answers itself.
I think Rati, this will be the last question. And after this, we can close the call because that summarizes everything. So Nikhil and Bala, just 2-3 USP you can say, and then we can sort of.
Okay, sure. So I'll give for IT first. Let's say 3 key rationale. One, technology we all know from a consumer perspective or a enterprise perspective, the influence of tech has been increasing and this will continue. And 2, if the opportunities in tech grow, then the opportunities for India also grow because India is has the largest talent availability for tech. And 3, from India digitalization story, the runway is much longer. It's far that drives the medium term spend. So these are the 3 key reasons why one should invest in technology. And from a timing perspective, like I mentioned, this is a sector with healthy fundamentals now available at reasonable valuations, which makes it a case for investing.
So I'll also just give 3 points. The first point is that almost after 8 years, we are looking at an exports upcycle. Indian companies are very well positioned in terms of their balance sheet. And I think at this juncture, when interest rates are running so high, it is the best competitive advantage to have when compared to global companies. So I think the exports is an opportunity which is very attractive today. The second is the domestic pharma and domestic healthcare services historically has been a structural space. It will continue to be a structural space. We are underinvested, underpenetrated. We have an aging population. We have a disease burden which is kind of increasing in the foreseeable decade or so. So that's why I think the domestic pharma space will generate a lot of shareholder value, which it has done in the past 10 years as well. And third is valuations. I think valuations has to be looked in conjunction with earnings. The earnings growth for this sector is looking very robust from a 3-year horizon because of issues, like I said, of so much of cost pressure in FY23, and those cost pressures will get properly absorbed in the coming 1-2 years. So I think
I think Nikhil's
for this
video
particular
is
fund.
paused.
I hope my 3 points were properly clear.
Nikhil, just repeat the last point.
Yeah. So the summary is that exports is an exciting space today. The domestic market is very structural, and the valuations are looking very reasonable relative basis as well as in light of the earnings growth outlook.
Thank you. So with this,
And
we
Rati,
come with the
sorry,
yeah, sure.
one more point is what I think, of course, Nikhil would have covered is that don't forget this $98 billion worth export opportunity which will coming up, trust going off patent and over next 5 years. That translates to 8 lakh crore of market. So, and Indians are known to capturing market share. So, if Nikhil is aware about it, you can be rest assured Cipla, Torrent, Sun Pharma, everybody is aware about this opportunity, must be working on it. So, I think that opens a big market for us. So, I think it's a structural story, India, because of the change in the disease pattern and life expectancy going up, etc., etc. With us, it's a structural story, but technically also some big export market may be opening up for us in times to come. So if you wait for 3 years and suddenly those opportunities will get noticed and then the valuation goes berserk, so better to start investing in such teams right away. Gradually keep on building up the portfolio in times to come, maybe by way of SIP or maybe by way of staggered purchases, and so that when the opportunity actually is unfolding, you play that team with the capital gains. Yeah, Pratik.
So with this, we come to the end of today's session. Thank you so much, Nikhil, Balaji, and Ashok for this enlightening session. So much in clarity one would have now to invest into this fund. A lot of questions were asked on this fund actually. So yeah, thank you so
Yeah.
much. Thank you to the
Thank,
partners
thank you,
for
Rajiv.
giving
Thank
your
you, guys.
time.
Thank you, guys. It was
And
brilliant.
Thank
we
you for
look
having
forward
us.
your
It's a pleasure. Yeah.
partners. We look forward for your support in this fund. Thank you so much.
Thank you, guys. Bye. Bye, Rati.
Thank you.
Thank you,
Bye-bye.
everybody.